Welcome to TaxLawGH and welcome to our next video in the series on capital allowances. In this video, we continue from where we left off in the first one, where we ended with the 500 cedis limit rule. I highly recommend that before you even continue watching this, you go back if you haven't watched part 1 of the capital allowance series, acquaint yourself with the basics, understand the different classifications of pools of assets, get to know the 5 pools of assets, get to know the special rules for mining and oil and gas or upstream petroleum operations, and then based on that foundation, come here as we delve deeper in this part 2 video. What we need to look at today basically is a number of concepts still under the topic or the concept of capital allowances. What we need to know right now is that with respect to a class 4 or 5 pool of depreciable assets, the allowance granted to a person or the capital allowance granted to a person shall not exceed or cannot exceed the depreciation basis of the pool at the end of the period, reduced by all other allowances granted to that person in a previous basis period. What this means is that under no circumstance can you grant more capital allowance than the balance in the pool. Let's use numbers. Let's assume that at the end of the period, your class 4 or 5 pool has a balance for the depreciable asset of 400 Ghana cedis. Fair enough. Under no circumstance can you grant capital allowance greater than 400 cedis for the pool to become for the pool to become negative. What this means is that when you have a balance, the maximum allowance you can grant as capital allowance is the balance on the pool. So the lowest a pool balance can be is 0. If the balance on the pool is 700 Ghana cedis, the highest amount of allowance you can grant is 700 Ghana cedis. You cannot grant allowance such that the balance on the pool becomes 0. Remember this concept, becomes negative. Remember this concept. The highest you can grant is the current balance on the pool. You can't grant more than the pool has. The principle is you can't give what you don't have, if you remember that popular saying. Now that we know that, we have heard a number of times depreciation basis, depreciable assets, we've heard of a pool. Let's look at what a depreciation basis is, or when it comes to defining the depreciation basis of a pool of depreciable assets. What is a depreciation basis? We are saying that for class 1, 2, and 3 assets, remember those classes are computed on a reducing balance basis. And for the purposes of revision, if you remember, I told you something like 4, 3, and 2. For those who watched part 1, you remember the rates using that memory jog. So we are saying that for class 1, 2, or 3 pools of assets, the depreciation basis is the total of a number of things reduced by something. So remember this. We are going to add 2 things together and deduct something. What are we summing? What are we adding? It's the total of the depreciation basis of the pool at the end of the previous basis period. If you are an accountant, this is what you probably call opening balance or balance brought forward. But because we are in tax, let's begin to use the term written down value instead of carrying value. So in your IFRS studies, in your financial reporting studies, in your corporate reporting papers, you are using the term carrying amount, carrying value, net book value. That is fair enough for accounting. In tax, let's get used to using the term or the expression written down value. So understand or memorize this, that written down value in tax is the equivalent of carrying value or carrying amount in accounting. So let's come back to this. We are saying the depreciation basis of a pool equals the total of the depreciation basis at the end of the previous basis period, which let's now call written down value brought forward. I'll take that again. Instead of saying opening balance or balance brought down or balance brought forward, let's say it equals, or the depreciation base of a pool equals the written down value brought forward, if any. So if it's your first year of operations, obviously you don't have any balance brought forward. But if you've been in operations, you have a written down value brought forward. And it's saying after deducting depreciation for that pool, calculated using the formula I showed you. So if you remember, A times B times C over 365 using that formula, and amount added to the depreciation basis of that pool during the basis period in respect of additions to the costs of assets in or added to the pool. What this means is that take your written down value brought forward, add to it or plus the cost of assets acquired during the year. So example, if you buy computers and data handling equipment, you will add this cost or the cost of the computer or the cost of the data handling equipment or the cost of the peripheral to which class? Can you tell me? Class 1 of the depreciable or the depreciation pools. When you add it to class 1, then you know that it is going to go for a rate of 40% on a reducing balance basis. So once again, the depreciation basis of a pool of depreciable assets equals the written down value brought forward. That's what the first bullet point means, which is the basis of the pool at the end of the previous basis period. So that's a written down value brought forward plus cost of additions or assets acquired or added to the pool during the year, and reduced, which is now going to deduct something or less something, reduced but not below 0. Remember I told you the balance on a pool cannot be negative, right? So reduced but not below 0 by consideration received for the assets in that pool or that have been in the pool during the basis period. What we mean here is that if for any reason you have realized or sold an asset in a pool during the basis period, you need to reduce the balance of the pool by the consideration and not the cost. Remember that when you acquire a depreciable asset, you add the cost of the assets to the pool. But when you realize an asset, you don't deduct the cost, you deduct the consideration received. In simple English, consideration received at the very basic level can be said to be how much money you received from selling the asset. Obviously, when you read the act, there are other ways of realizing assets apart from sale. When you destroy an asset, the asset is even realized. When you transfer the asset, when it is redeemed or destroyed or lost, we can even say you've realized the asset. But at the basic level, let's say you sold the asset, you have realized the asset. If you sold the asset for 5,000 cedis, then you would deduct 5,000 cedis from the pool of depreciable assets to get the whole or the total balance of the pool. If you do this properly, then your written down value brought forward, for those who are interested in formulas, right? The written down value brought forward plus additions or cost of additions during the year minus consideration received from assets disposed of equals written down value carried forward. I'll take that again. If you want to find the written down value of a pool at the end of the basis period, you need to do a number of things. I'm reducing these 3 bullet points into one equation, which is your written down value carry forward. That is at the end of the year to be carried forward into the next basis period equals written down value brought forward, which is your opening written down value, plus additions, which will be the cost of assets acquired during that basis period. Then less, or you deduct the consideration received from assets disposed of or realized during the year. This is what will give you the depreciation basis of class 1, 2, or 3 pools of depreciable assets. Armed with this knowledge, let's look at the equivalents for class 4 or 5 assets. And for those who've been following the Capital Allowance series, you realize that we group class 1, 2, and 3 together, and we almost always group 4 and 5 together. And the reason is simple. It's the way the law recommends we compute capital allowances on these pools. So class 1, 2, and 3 are all on the reducing balance basis. Class 4 and 5 are in substance on the straight line basis. So let's look at 4 and 5 bundled together. We are saying that the depreciation basis of a pool of depreciable assets at the end of a basis period in respect of a class 4 or 5 pool of assets is the total of the depreciation basis of that pool at the end of the previous basis period. Nothing has changed here. It's the same written down value brought forward and amounts added to the depreciation basis of that pool during the basis period in respect of additions to the cost of assets in or added to that pool. Nothing has changed, plus additions or cost of assets added, and reduced but not below zero by the consideration received for the assets in that pool during the basis period. So you can see from here that this is almost a striking mirror image of the rule for arriving at the depreciation basis of a pool of class 1, 2, or 3 assets at the end of the year. So here, once again, in summary, the written down value carried forward will equal your written down value brought forward plus cost of additions minus disposals or consideration received from realized assets. But once again, remember that because class 4 and 5 assets are on the straight line basis, assets do not lose their individuality. If you watch part 1 of this video series, remember I told you that for class 1, 2, or 3 assets, pools of assets, when an asset enters the pool, it loses its identity. So you don't go into the class 1 pool trying to find your Apple MacBook or your iPad. Your iPad and your Galaxy Tab will become one in the pool. They lose their identity. It just becomes a thing of numbers. It's the numbers that now count. Unlike 4 and 5, where if you have a building at Kaswa, if you have a building at Medina, those two buildings will be separate assets in the class 4 pool. Remember, class 4 is for buildings, structures, and similar works of a permanent nature. What we are saying here is that for class 4 and 5, because they are in their own individual sub pools within the major pool, what you need to do is to track everything on an individual basis. So if you are adding more to a building, you need to ensure that you create a different line for it, such that, if you remember the example from the first part, what we said was, even for buildings that have multiple floors, or let's say use story buildings, what you do is, if parts of the building are completed in stages or in different years, you capitalize each floor of the building separately, technically, right? Such that the ground floor can be capitalized in year 1, then the first floor can be capitalized in year 2, in that order. In that case, if for any reason you decide to dispose of the ground floor, I don't know how feasible that will be, and then you still own the first floor, you will realize the ground floor only, because for class 4 assets, you will have a separate line for the cost of the ground floor, the additions, if any, let's say you made some improvements to the ground floor, and you can deduct the consideration you received for that particular ground floor. So remember that for class 4 and 5 assets, you don't mix things together. Keep each asset separately. Same for class 5. Let's assume that class 5 pool is for intangible assets. So let's say you own a number of software licenses. You have one for Microsoft for, let's say, Office. You have another software that is used for designing or editing video. Let's say one of the Adobe Pro softwares. All you need to do is Microsoft will be on its line separately. The Adobe software will be on its line separately. Let's say you have another software that is used for mixing music. That music mixing software will be on its own line, such that if you are selling the Microsoft Office, you will deduct the consideration received from that same Microsoft Office line, because you don't mix things in pool 4 and 5 together. That should be very, very clear. When we start doing the computational aspect, you begin to see some of these things a lot more clearly. Let's look at partial usage of an asset. This is where you use an asset for dual purposes, maybe partly in the business and partly for your own personal uses. What I'm saying is that where by reason of a depreciable asset owned by a person being partly used in the production of income from a business, only part of an asset is placed in the pool of depreciable assets, and the Commissioner General shall apportion the costs of that asset and the consideration received for that asset according to the market value of the asset, or the part of the pool which has been included in the pool and the part which is not placed in the pool. What are we saying here? In simple language, in plain words, if for some reason you have a car or an office car that is used 60-40, and the ratio is 60% for business, 40% private. By private, your driver drops your children at school. In fact, drops your 5 children at school in the morning before bringing the car to work. On Saturdays, that's what you use to attend all your weddings and funerals. Then on Sunday, you attend church. You are an elder in 3 different branches. So the car is used a lot for your personal purposes. What the law says is you are not going to put the full cost of the car in Pool 2. Why? Because part is used in the business, in this case 60%, and then 40% for personal use. That aside, we are saying that where, you remember we said, if you are to sell the assets, you deduct the consideration received. And what we are saying here is that Commissioner General recommends, or he will prescribe to you, that you use the market value to apportion how much should be granted as consideration. So let's say we are saying market value of the parts in the pool and the parts not placed in the pool. Let's assume the car is $100,000. That's the cost of the car. Remember that if the cost of the car is $100,000 and we are going by my 60-40 example, then $60,000 will be business value. Then the remaining $40,000 will be personal value. What we can allow you to capitalize, essentially, is the $60,000 portion. The remaining $40,000 you cannot capitalize. And when it comes to you selling the whole car, let's say you sell the whole car for $120,000. Remember that all things being equal, if the car was wholly used for the business, we would have deducted the consideration received from the whole Class 2 pool. What we are saying here is that because you are using parts for business and parts for personal purposes, we will use the market value of the car to apportion the consideration such that you are selling for $120,000. We understand. But let's look at the value of the portion you are using in the business and the market value of the portion you are not using for the business, and use that to prorate the $120,000 consideration. So in the end, it is the market value portion of the portion that is used in the business that will be deducted as consideration received from the pool or the Class 2 pool in this particular example. Remember, market value is used to do the apportionment where there is part usage in the business and part usage for personal purposes. Next thing we need to know, which is also very common for exam purposes, it's actually one thing that is guaranteed to be in every exam on capital allowances. Once there is a capital allowance question and once there is a computational element, I am yet to see one single question that does not find a way to test if you know this rule. It's called the motor vehicle restriction. Here we are saying that, remember once again, that motor vehicles go into which pool? Pool 2 or Class 2 of depreciable assets. We are saying that for the purpose of computing capital allowance, the cost of a road vehicle other than a commercial vehicle, so it means commercial vehicles are not part of this rule. I'll define that shortly. We are saying that the cost of a road vehicle apart from a commercial vehicle is not recognized to the extent that it exceeds 75,000 Ghana cedis. So it means that if you have a car or a road vehicle that is not a commercial vehicle, take note, the maximum amount you can add to the Class 2 pool is 75,000. Let's define commercial vehicle so that we are clear in our minds. We are saying commercial vehicle means a road vehicle which is designed to carry a load of more than half a ton or more than 13 passengers. So all the buses on our road that act as trotros will qualify as commercial vehicles because they obviously carry more than 13 passengers, unless it's a very small bus. But a typical trotro on the road carries more than 13 passengers. So because of that, if a company that owns a fleet of buses is capitalizing its buses, obviously for their bus, which carries more than 13 passengers, it is going to qualify as a commercial vehicle. As such, if they bought the car for $200,000, they are allowed to capitalize the whole $200,000. Let's give another example. You're a business owner. You own a Corolla, right? That's your car. Can a Corolla carry more than 13 passengers? No. Can a Corolla carry more than half a ton? I don't know, but you might just break the car, right? In that case, a Corolla is not a commercial vehicle. So as such, the Corolla will be within the 75,000 cedis threshold. If you buy the brand, the newest version, might probably be in the region of 90,000, 100,000, I'm not too sure, right? We are saying that we don't care how much you bought it for. if it doesn't qualify as a commercial vehicle, we are capping your amount of capital at 75,000. So let's say for some reason you buy a Corolla that does so many magical things and it costs 120,000 cedis. You can only capitalize 75,000 cedis. Remember this rule for motor vehicles. Also, still under the definition of commercial vehicles, we are saying a vehicle used in a transportation or vehicle rental business is a commercial vehicle. So once it's clearly a business you use for transportation or for rental, then it is a commercial vehicle. So here, there's some argument that, well, because the law says the first bullet or the second, which is either the half tonnage or more than 13 passengers or used in rental, then it means the same Camry. If you're using the Camry in a rental business, then it could qualify, the whole amount or the whole cost could qualify, provided that you are using the Camry wholly in the rental business. But remember that if it's not a business or a rental business you are running, then the amount of motor vehicle cost you can capitalize in your class 2 pool is limited to 75,000 Ghana cedis, unless it is a commercial vehicle, which we've defined in detail here. The next thing we need to know is realization of depreciable assets. Realization of depreciable assets. Remember, I told you realization has a number of meanings within the law. When you sell an asset, you realize. When you transfer an asset, you realize. When you destroy an asset, you realize. When you redeem an asset, you've realized. There are other terminologies that you need to be aware of. For now, let's take realization at a basic level to mean when you've sold, just so you remember. When we do the concept of further topics around the Income Tax Act, we'll look at realization, investment income, and all of those. We are saying that for the purpose of computing the income of a person for a year of assessment from a business in which a depreciable asset of a particular class was employed, the Commissioner General shall include the excess of the following two amounts. Let me explain the reasoning behind this particular part. What we are saying here is that if you've done some accounting, or in fact in general common knowledge, right, there's something called profit on disposal and loss on disposal. And if you've done accounting, you know profit on disposal is other income which will be added to the income statement for financial reporting purposes. If you make a loss on disposal, then the loss is typically an expense which will be deducted from your expenses in arriving at your profit for financial reporting purposes. Tax is trying to accomplish something similar here. So if you understand that concept, let's come here. For those with no accounting background, let's say law students or just people wanting to learn tax, what we are saying for realization here is that if you buy your iPhone for 5,000 cedis and you sell it for 7,000 cedis, 7,000 is how much you sold it for, 5,000 is what it cost you. What's the difference? 2,000. You made a profit or a gain on disposal. Agreed? Good. If for some funny reason you bought your iPhone for 5,000, you cracked the screen, so you could only sell it for 2,000. Now it cost you 5,000, you could only sell it for 2,000. You've made a loss of 3,000, so you lost money, right? That is the concept we are using here, if that helps. We are saying that when it comes to computing the income of a person for a year of assessment, the Commissioner General shall include the excess of the following two amounts. First is the consideration received by the person during the year for any assets that was in a particular pool of depreciable assets of the year, reduced by, so it means you take the consideration received, which is how much money you received from realizing the assets, reduced by the below as appropriate. We are saying in the case of a class 1, 2, or 3 pool of depreciable assets, the depreciation basis of each pool at the end of the year, but disregarding the consideration received referred to above. What we are saying here is that where there is a realization, the excess of the following two amounts shall be included or shall be taken into consideration in computing the income of a person from a business. So you take the consideration received and reduced by, or you less the depreciation basis of the pool, right, which has not taken into consideration the consideration received above. What I mean is consideration received less depreciation basis of the pool, not factoring in the consideration received. In the case of class 4 and 5, it's the written down value of the pool at the end of the year. But once again, written down value that has not been, or that has not had consideration received deducted from it or factored into it. Remember this carefully. There should be good. This is something that will help us arrive at something reasonable. So what happens where the assets in a pool have all been realized? We call it full realization of all assets in a pool. We are saying where the assets in a pool of depreciable assets are all realized by the person before the end of a year of assessment, the person shall dissolve the pool because there's nothing in the pool. You sold everything. And two things: include in the income of that person an amount that is calculated using the formula A minus B. Let me show you what A is before we come to the next point. If you look down here, we are saying A is the consideration received by the person during the year of assessment for the assets. And what is B? I'll come back shortly. B is the sum of two things: the written down value of the pool at the end of the previous year of assessment and the amount added to the pool during the year. So we are saying that in summary, B, if you watch it carefully, B is written down value brought forward plus what? Additions, basically. So that gives you what the pool has. So if we come back here, we are saying that if A, which is consideration received, exceeds the value of the pool, then you have made a gain which you must add to your income and tax you. Let's come back to the iPhone example. I said you bought your iPhone for, let's say 5,000, yes, and you sold it for 7,000. You made a gain of 2,000. That gain is money, is income, is profit, taxable. What we are saying here is same principle. We will include in your income an amount for it to be taxed if your consideration received, which is A, exceeds the total value of the pool, which is the written down value brought forward plus any additions in the pool. Remember. Or if you make a loss, here we are saying you will be granted an allowance for the year. Granted an allowance means that we will give you an extra deduction because it's a loss, it's an expense. So if B exceeds A, let's say the consideration you received is less than the value of the pool, then we'll grant you an extra allowance. So it means we'll give you an extra deduction. So remember, you will have income included in your taxable profits where your consideration received exceeds the value of the pool. Remember, this is where you realized all assets in the pool, and you'll be granted an extra allowance, given an extra deduction to reduce your taxable profits where you've made a loss. So in that case, your written down value of the pool or the total depreciation basis of the pool exceeds the consideration where you make a loss. You'll be given an extra deduction. So we are saying written down value of a pool at the end of the year means in the case of class 1, 2, or 3 pools, the basis of the pool at the end of the year, if any, after deducting depreciation for the year. In the case of 4 and 5, the same principle. So we know what written down value means. It is the total at the end of the year, which is written down value brought forward plus additions less any realizations. Remember, this is very, very crucial. So what am I saying here? Remember, for the purpose of computing capital allowances, a person realizes a depreciable asset only if that person sells to another person who is not an associate of the business in respect of which the expense was incurred. We define associates to be, at the basic level now, people you have a relationship with, business associates, related parties for those who are accountants, anybody that you may not transact with on an arm's length basis is deemed to be an associate. So we are saying for capital allowance purposes, you are only deemed to have realized an asset if the sale was made to somebody who is not your associate. So an independent third party, an unrelated third party. So let's pause here for now and we will continue in the next edition, next part of capital allowances. So don't forget, as always, if you love this, please smash the like button and share this video within your network. I will catch you shortly.